Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a couple of different things. First, we look at S&P 500 valuation, both on a historical basis and then looking forward. Then we look at growth to value because that's another area when growth is outperforming value that tends to be more positive for the market. Then we look at other markets outside of the S&P 500, other sectors, other indexes within the stock market, and then we even look at other markets. No market exists in a vacuum. Sometimes we can get some clues about what is happening with stocks by looking at these other markets. This is being prepared for Monday, April 8th. The first area is S&P 500 valuation. We look backwards at the trailing 12 months. These are earnings reports that have already been released, and we compare that to the PE ratio. When we're at a PE ratio of 10 or below, stocks are considered to be inexpensive or cheap. Between 11 and 19, stocks are fairly priced. When we're at 20 or above, stocks are considered to be expensive. Looking at this chart, we see the black line of the S&P 500, and then we have the red dashed line, blue dashed line, and green dashed line. We're well above the red dashed line, and then it's blown up more down here on the bottom, showing that on a historical basis, stocks are considered to be overvalued. But this can last for a number of years. We don't use this to make decisions. We just want to be aware of what the historical valuation is for the stock market. This is another chart showing different events that have happened and what the valuations were at that time, just to give you a little bit of a perspective. Then we look at another measurement. Excuse me. I have to keep clearing my throat here. This was developed by Robert Shiller. And instead of just looking at the last 12 months and measuring that out, we look at a more smooth process over a 10-year period of time. And this just helps to give us an idea of where are things valued on a historical basis, but using a slightly different method. Currently, with the Shiller PE ratio, we're coming in at 34.55. Well, to give us some context, we can look at a historical chart, and we can see that we're pretty high right now compared to where stocks have been in the past. We can also look at the median and the mean, which is just a little bit under 16 for the median and a little bit over 17 for the mean. So we're about double on a historical basis of where stocks are normally valued with where they're valued right now. So this also suggests that on a historical basis, stocks are expensive. Again, we don't freak out over this. We don't really make decisions based on this unless you're a pure fundamental investor. When we use technical analysis, we just want to be aware of this. Then we look forward because that's what the market does. And I have a number of different indexes here. The red line is the S&P 500. With the pullback that we saw this past week, we're currently at 21 times earnings looking forward for the S&P. So we're a little bit above that expensive level, even looking forward. So that's a little bit of a concern for the market. When we look at some other indexes like the mid caps and the small caps, we're much lower. We're at 16.3 for the mid caps and 15.3 for the small caps. So they are more fairly priced looking forward. Then we look at growth versus value. This is just a pure growth index, growth all by itself, showing that it's in an uptrend. Then we look at value all by itself, and this is also in an uptrend. So independently, they're both doing pretty well. Where we get some insight is when we do ratios between the two. On top, we have growth versus value, showing how growth is outperforming. On the bottom, we have value underperforming growth. And one of the reasons why I look at a lot of different charts and we look at inverse charts is there can be a bit of an offset of when moving averages cross or what valuations we're actually seeing, because each one of these is calculated in a little bit different way. Then we look at an ETF of growth versus value, showing how growth is outperforming. This is showing how value is underperforming growth. Then another growth to value index, a little longer term, where it has been pulling back, but growth is still outperforming. This is also showing how value is underperforming growth. Another index looking at how growth is outperforming value. And then here's using some different ETFs where growth has been pulling back on a ratio basis, but it's still outperforming. Value has been bouncing back up, but still continues to underperform. So we have a number of different ways of looking at this, and we kind of reach the same conclusion. Growth is outperforming value, but it has been pulling back lately. Then we break it down a little bit more. These are the small caps, and I've been showing these charts in every daily video where we were looking pretty solid with the growth to value ratio, but now we've been pulling back. And this is the index that's been really frustrating for the markets because we're not really breaking out. It's the last index to hit an all-time high. All of the other ones that we follow are either at or near all-time highs. The small caps are just not participating. The mid caps, coming off of a recent all-time high, also showed that mid-cap growth is outperforming mid-cap value, even though this ratio has been pulling back lately. This is the one that we focus on for the S&P, where growth is outperforming value, but it has been falling back lately. Then we keep an eye on inflation. This is a monthly chart, the CRB index on top, where it's starting to go back up. It's above its moving average. Then we look at a ratio down below between inflation and deflation, and we're below a declining moving average, but we have been ticking back up as some of the economic reports that have been released lately have been stronger than expected. We're also seeing some commodities start to show some signs of life, and that could be somewhat inflationary, and oil's been going up, gold's been going up. So we just want to keep an eye on this, but it doesn't seem to be a big problem, at least yet. Here's a daily chart of the CRB index where we're seeing a recent golden cross as commodities have been going higher. And we're wondering if we're switching into another environment where it's okay for commodities and stocks to both do well, especially if we're in an environment where interest rates are going down. And that's what the market is really trying to figure out right now, because it looked like, okay, they were going to have 3 rate cuts in 2024. Now we've been seeing some stronger than expected economic reports. That's throwing that into doubt. There's been some comments from the Fed saying, well, maybe we're not going to cut rates at all, just to kind of tease the markets a little bit. But that's has the market uneasy right now. And looking at the Baltic Dry Index, we look at this from an inflation standpoint. Typically, when this is going up, that's inflationary because it costs more to ship products. Now it's been coming back lately. So this is actually non-inflationary currently. Some other markets that we just look at, we want to keep an eye on these different areas. Aluminum is still in a downtrend, but it has been bouncing back up. Another few days staying above these moving averages, and this could actually turn into an uptrend. Corn continues to be in a downtrend. Wheat is also in a downtrend. Fertilizer has also been declining recently for over the last 3 weeks to month or so. Oil, this has been going up mainly because of tensions that are in the Middle East, specifically between Iran and Israel, but the whole Middle East is really unsettled. And this can be more negative for stocks. It depends on the context. If oil is going up and the oil companies are making more money, that can be very helpful for stocks. But it's rising right now due to tensions that are going on, and that can be more negative for stocks. So that's why we're keeping an eye on this. Gas is also more in an uptrend now, and you probably feel that every time you fill up your vehicle. Diesel been coming down. It spiked up a little bit here back in February and then has been trailing off. This is really impacts those things that are moved by either trucks or trains. Heating oil continues to be in an overall downtrend and has been chopping sideways lately. Natural gas continues to see more weakness. Copper, and this is more of a barometer of the economy. When copper's going up, that means the economy is looking better going forward. And right now it's in an uptrend. Then we do a copper to gold ratio, and gold's been breaking out to all-time highs. Copper's in an uptrend. And so we've been chopping more or less sideways recently with this overall ratio. And I have to clear my throat again. It's really funny. When I start recording this, I test my voice, I take a drink of water, everything's fine. Then I start talking and everything changes. This is a longer term chart of the copper to gold ratio. That's the black line, where overall it has been declining as copper's been underperforming gold. We also plot the 10-year yield and the 2-year yield on here just to get some perspective. And we could be changing interest rate environments that I'll go into a little bit more later. That's why we're seeing a really wide spread between all of these, even though they are all on different scales. Gold continues to set all-time highs, has a lot of the gold folks quite happy. And silver has finally crossed over into an uptrend, and it's been really showing some improvement lately as well. Then we look at the closing price for gold on top, the closing price for silver, and we see that the correlation between the two is quite strong. Now, that would only make sense, and that's logical, but there are times recently where they really haven't had a solid relationship. Gold was going up as silver really wasn't doing all that much. Now they're getting back more in line with each other. Then another study that we look at is the gold to silver ratio on top. When this is going up, gold's outperforming. When this is going down, silver's outperforming. And then we plot the US dollar index in the middle. Right now, we're not really getting any insight from this because we look at the relationship between the upper chart and the middle chart, and they're pretty much neutral right now. When there's a high correlation, sometimes that can give us some clues as to what's happening in either market. And the dollar has been seeing some strength lately. We just saw a recent golden cross here, and we're just starting to see a golden cross on the weekly chart as well. And this could put some pressure on stocks. Stocks like a weaker dollar, because of the exchange rate and the import-export is just more favorable in that kind of an environment. Here's another look going back over 3 years, showing how we're breaking out above this downward sloping trend line, but now we're coming back down to the trend line itself. And we keep an eye on the euro, which has been going sideways compared to the dollar index. We also want to keep an eye on the Japanese yen and the euro and the dollar all together here. Then I have a breakout chart where the moving averages are right on top of each other when we compare the euro to the US dollar. And we're in a downtrend with the Japanese yen when we compare it to the dollar. The British pound is still in an uptrend, but has been pulling back lately compared to the dollar, as the dollar has been seeing some recent strength. Then we can look at different indexes, and I do show this in the daily video. The black bar chart is the S&P 500. That is a weighted index, so the bigger stocks have more of an impact on the calculation of the S&P 500. Well, to try to make it a little more fair, we look at an equal weight index where all stocks are treated the same, and they're performing about the same right now. They both have been going up. We're not really seeing any kind of massive outperformance. We were going through a real period of time where the bigger stocks were really leading the market higher. It's actually come a little bit closer lately. Then we look at the equal weight index and compare it with the S&P 500, where when this is going down, that just means that the equal weight index has been underperforming, but lately we're starting to kind of flatten out here. Then we look at a ratio between stocks and commodities, showing how stocks are outperforming, but as commodities have seen some strength, that's pulling this ratio down. Here's an inverse of that same chart, showing how commodities are underperforming, but seeing some recent strength. Here's the NASDAQ 100, which is coming off of all-time highs, the S&P 500 coming off of all-time highs. Longer term, the NASDAQ 100 is outperforming, but we are drifting lower. Now, you could take this as positive because the S&P 500 is a bigger index and it has more value type stocks. And it's also more of a broad market measure of what's going on with stocks. So the fact that this is actually coming down could suggest that there's more broad market participation. Then we look at a ratio between the S&P 100, the biggest stocks that make up the S&P 500, also seeing a bit of a pullback here, and we just saw a recent death cross with this ratio. Not necessarily negative, it's just showing more of the other stocks in the S&P 500 are starting to participate in the upward move. We look at the NASDAQ, which is doing really well, and the S&P 500. Overall, the NASDAQ is outperforming, but also lately it's been pulling back, coming down to this longer-term moving average. We'll look at the NASDAQ 100 and compare it with the NASDAQ. Pretty much the same story. The NASDAQ 100 has been outperforming, but now coming back down, also suggesting that we're seeing the rest of the NASDAQ perform better. We look at the mega caps, the really monster companies, and compare it with the equal weight ratio. And the big companies are still doing a lot better. They've been chopping more or less sideways, but they're still in an uptrend when we compare it to the rest of the equal weight S&P 500. Then we want to keep an eye on small caps. This has been an area of disappointment. A lot of folks, they're waiting to get into small caps, or they got into them and it's been really frustrating. The red line here is a ratio. When this is going down, that means small caps are underperforming the S&P. They're in an uptrend all by themselves, but when you compare them with the performance of the S&P 500, they continue to underperform. Just to get a little perspective, in blue here, this is the S&P itself. Here's a ratio between small caps and the S&P, also showing how small caps continue to underperform. We want to see this turn and go up and see a golden cross here if we're going to turn more positive on the small caps. Here are the 30 biggest software companies continuing to be in an uptrend, but still have a ways to go to get back to their all-time high. The mega caps, these have really been leading the market higher, have been pulling back lately, but still in a pretty solid uptrend. The robotics and AI ETF, this is the craze, this is the fad these days, this is what people are all talking about. It's in an uptrend when you look at it by itself, even though it has been seeing some weakness. When we compare it to the tech sector, it's starting to underperform. It had been doing better. We got right up to this slower moving average, and now we've been pulling back. So it's not as strong as a lot of people would have really hoped. Then we look at the Dow Jones Composite Average. Well, this takes the Dow, the transports, and the utilities. And pretty much all the strength right now is coming from the Dow. The transports, utilities, So the reason this is going up is because of the Dow itself. We look at the S&P 500 to compare it with the price of 1 to 3 year bonds, showing how stocks are outperforming, even though they've been pulling back recently. We look at a broader measure, the S&P 1500 with shorter term bonds. This is suggesting that there's more broad market participation in stocks as they outperform shorter term bonds. We look at another broad market measure and then go further out with bonds, showing that stocks continue to outperform. Then here's the total U.S. stock ETF. This is 2,651 stocks coming off of recent all-time highs and in a pretty solid uptrend. The low volatility ETF, when you look at it all by itself, it's in an uptrend. But when you do a ratio between the low volatility ETF and the S&P, it is really underperforming. Then we look at the tech sector and compare it with 3 to 7 year bonds, showing how the tech sector is still outperforming, even though it's pulling back recently. And then we look at an advanced decline line studies chart here, and I show this in every daily video. We're still looking good with NYSE common stock. We're above an advancing moving average. The same thing is true with the S&P 500, the mid caps. The small caps are lagging. They're a little bit closer to their moving average, but they are still barely above the moving average. We look at Dow theory. We did see some weakness in the Dow, but it's coming off of recent all-time highs. The transports have been going sideways. This is a Dow theory non-confirmation. And that's a negative sign for right now. If we're actually seeing the economy shifting over to an environment that may help the transports, then we eventually want to see the transports going up, setting a new all-time high, and that would be a Dow theory confirmation. But we're not seeing that yet, and the utilities have been under some weakness lately. Here's the transports all by themselves, where they've been chopping sideways pretty much in 2024. We haven't been able to get back to this previous high set in July of 2023, nor the all-time high set back in 2021. We look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming, and that's what has consistently been happening lately. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And for the most part, that's what has been happening. And we look at a relationship between the S&P on top and the transports, and they're having a pretty strong correlated relationship. So if the S&P is going up, chances are the transports are going up. And the inverse of that can also be true. If we have weakness in the S&P, the transports could also be showing some weakness. Then here's a new look at Dow theory, where instead of using the Dow, we look at the S&P 500, since that may be a better representation of the U.S. economy. And then instead of using the transports, we use the NASDAQ, because the NASDAQ is more tech. And we're coming off of recent all-time highs with the S&P, also recent all-time highs with the NASDAQ. So this new way of looking at Dow theory is providing some confirmation. And we break it down a little bit further. Instead of looking at the S&P 500, we look at the S&P 500 equal weight, which is just coming off of setting recent all-time highs. Then we look at the QQQs, which is the NASDAQ 100, and we use an equal weight ETF, seeing some weakness right now, but still coming off of recent all-time highs. So these are confirming each other for the time being. We look at the Wilshire 5000, which is another broad market measure, showing how stocks have been pulling back a little bit lately, but are still in a longer-term uptrend. The FANG index has been going sideways lately, but still in an uptrend. And then we want to keep an eye on this. If we start to see some weakness, these are other areas of possible support. ARC is in an uptrend, but not really participating with the rest of the market right now. And then we look at a monthly chart of the S&P 500 and then take a ratio of stocks in Europe, Australia, Asia, and the Far East. When we're above this red line, that means the S&P 500 is outperforming, the red line's going up, and for the most part, the price chart is going up. We also plot a momentum indicator down below, and that's continuing to go up, showing that U.S. stocks are stronger than stocks in the rest of the world in the longer term. This is a monthly chart. And we look at bonds, which continue to be in an uptrend based on price, but they've been chopping sideways. Here's the World Bond Index, also still in an uptrend, but very choppy right now. And then we look at a monthly chart, and we compare stocks with bonds, showing how stocks are outperforming. Then we switch over to a daily chart, showing how bonds are underperforming stocks. So we're seeing confirmation on a short term on a daily chart, and then long term on a monthly chart. These are high-yield corporate bonds. We also know them as junk bonds, just coming off of setting recent all-time highs. Investment-grade bonds, more conservative, also in an uptrend, chopping sideways to slightly down, and still quite a ways to go to get to a new all-time high. We do a ratio between riskier bonds like junk bonds and more conservative bonds, showing that folks are still favoring the riskier bonds. They're willing to take on that risk to get the higher yield. Now, if we do switch to an environment where interest rates are coming down and possibly longer-term rates have been locked in and will start to decline, we would see this ratio coming down. And every once in a while, we see it start to come down. But now that we've been getting some pretty strong economic reports, this ratio is starting to go back up. We look at a correlation between stocks and bonds, and they're having a little bit of a tendency to go in the same direction. So we look at stocks based on price and bonds based on price. Their correlation could be stronger than it is, so they're just kind of a little bit going in the same direction. We look at the Dow Jones Corporate Bond Index, continues to be in an uptrend, but for 2024 has pretty much been going sideways. We look at the 10-year yield and have some Fibonacci lines on here. We hit 5% back in October. We've been coming down. Now we've slowly been starting to go back up. Then this is longer term, going back to 1980, where we saw 40 years of a lower interest rate environment. And now we're wondering, are we shifting back more to a higher interest rate environment? And this takes some time to really work its way out to let us know what's going on, but that's what it appears to be for right now. And this is a chart that I've been showing for a long time. Way back in October, we came down and had a real low reading on this chart. Now, this was a positive thing. The market was sure that we're going to have a soft landing, meaning that we're not going to go into a recession, even though we've been seeing some economic weakness, and that the Fed will start cutting rates. That's when we topped out with interest rates, we bottomed with stocks, and then just roared into the end of 2023. Now, that's great. But other times when we're seeing a reading like this, this is when negative things happened. So we have two negative things here and a positive thing, and we just want to keep an eye. Even though everything is okay right now, even though there's some geopolitical tension, that could change at any time. We're also keeping an eye on the banks because we had New York Community Bank come out with some pretty negative news. So far, we're not really seeing anything in other banks, but we want to be really watchful of those things. We look at the 30-year yield, which is really not near a Fibonacci retracement level. We compare the S&P 500 with the 10-year yield, showing how we've been going sideways, but the S&P has been outperforming. And we look at the 3 to 7 year bonds and compare it with stocks. When this is going down the way it has been, this just means bonds based on price are underperforming. We look at junk bonds, really close to setting all-time highs and in a pretty solid uptrend. We look at junk bonds and compare it with government bonds. And as I said earlier, if this is going up, there's more uncertainty about the interest rate environment, fearing that interest rates are going to go up. If we start to see this coming back down, that probably means that interest rates have topped out and will come down. Folks will get out of the more risky bonds and more into the conservative bonds, but we're just not seeing that. We've seen a few false starts along the way, but now we're starting to head back up with this ratio. We look at the price of the 7 to 10 year bond ETF. We're below 50 and declining with the RSI. We are in an uptrend, but going sideways with the trend, and we're seeing negative momentum in the shorter term. Here's a daily chart of the yields where we had been coming down. Now we're starting to go back up. Here's a weekly chart looking internationally with the US, UK, and German rates going up, and even Japanese rates were up in the latest reading. We look at the MOVE index on top, which measures the volatility of bonds, then the VIX, which measures the volatility of stocks. And they're having a pretty strong correlated relationship right now. Doesn't necessarily mean price is moving in the same direction, but volatility is moving in the same direction as the market is dealing with some uncertainty. And we look at a monthly chart of the price of the 30-year bond, and that is in a downtrend. But when you compare it with the CRB index or commodities, bonds are continuing to outperform. But this is a monthly chart, and this can take a while to readjust. We look at different sectors. First, I look at the sectors all by themselves, and then I compare them to the S&P. Materials are in an uptrend and been doing quite well lately. And they're also showing some improvement when we compare it to the S&P, but still, longer term, they are in a downtrend. Communication, this has been one of the stronger areas, and all by itself, it's in an uptrend, and it's even outperforming when we compare it to the S&P. Energy, really making a comeback lately as there's some geopolitical tensions, so it's looking pretty solid here. It's still in a downtrend longer term compared to the S&P, but it's been bouncing up pretty fierce lately. The financials continue to hang in there, and this is an area we want to keep an eye on. So we're in an uptrend here, and we're also outperforming when we compare it to the S&P. Even though we haven't really broken out here, the price has been holding up. Industrials also have been doing quite well lately and are in an uptrend and are starting to outperform on a ratio basis. We're just seeing a recent golden cross with this ratio. The tech sector has been one of the stronger areas, but by itself, it's been going sideways quite a bit lately. And it's still in a longer term uptrend compared to the S&P, but you can see how it's been fading here. The staples sector, which when you look at it by itself, continues to be in an uptrend, even though it has been pulling back. It came down to its 50-day moving average. But when you compare it to the S&P, it has been underperforming. This is more defensive. This is an area that held up really well in 2022 when the market was under pressure. In 2023 and so far in 2024, folks are favoring more the growth areas, or they're trying to get into the discretionary areas, but because of Tesla, discretionary has been underperforming. We'll look at real estate, kind of going sideways now, still in an uptrend by itself, but really underperforming when we compare it to the S&P. This is very interest rate sensitive. Look at utilities. Just seeing a recent golden cross here as utilities have been bouncing back after being in a downtrend for quite some time. But when we compare it to the S&P, it's continuing to underperform. And then we look at a ratio between the S&P and utilities. When this is going up, the S&P is outperforming. Lately, it's been coming down as stocks had a down week this past week. We look at healthcare, more defensive area. It's in an uptrend, but it has been pulling back, and it's really underperforming the S&P on a ratio basis. Discretionary, as I like to say, this is what makes life fun. When we look at it by itself, it's in an uptrend, but when we compare it to the S&P, it's underperforming. Semiconductors, a huge part of the tech sector, continues to be in an uptrend, even though it's been chopping sideways lately. And then we look at energy, which is in a downtrend longer term, but since oil prices and the energy sector has been seeing a rebound, it's really coming back up, but not enough yet to give us a golden cross here. Then we look at the growth areas and compare them with the price of bonds, showing how growth stocks continue to outperform. We look at the tech sector and compare it to the 10-year yield, showing how the tech sector is outperforming. Here's an inverse showing how the 10-year yield has been underperforming. We do a discretionary to staples ratio, been chopping more or less sideways, seeing a weakening trend, but discretionary is still outperforming. Here's an inverse, showing how staples have been going sideways, showing a little bit of an improvement, but they still continue to underperform discretionary. We look at gold, which is setting all-time highs, but when you compare it to the S&P, it has a long way to go to see a golden cross with this ratio. We also compare gold to the dollar, where it's starting to break out above this longer-term trend line now. The dollar's been going up, but gold's been going up even more, and that's why we're seeing this ratio going up. High leverage loans, these are very risky. They continue to be at or near all-time highs, suggesting that the economic projections looking forward are positive. The NYSE composite, another broad market measure, is in an uptrend. All stocks, looking at the US as well as international stocks, pulling back recently, but still in an uptrend. Emerging markets, chopping sideways, but seeing a little bit of an improvement here and in an uptrend currently. The Japanese Nikkei, which is their big stock market index, finally broke above the 1989 highs. Been pulling back a little bit, but still quite near those all-time highs. These are the micro caps, smaller companies. They continue to be in an uptrend. And we have a home builder study here. We're not really getting anything from this. We have the S&P on top and the home builders ETF, and then we do a ratio and a correlation down below. We're looking for divergences here. And because we're getting a high reading with the correlation, that's not really telling us anything right now. Bitcoin coming off of recent all-time highs as it's been chopping around lately. And then we look at a weekly chart internationally where China is in a downtrend, as are the emerging markets, Europe, Japan, and even we're seeing some weakness now in the US. Intermarket analysis chart going back to the beginning of the year where oil is doing the best, followed by gold, which has now gone into second place, then stocks, then the dollar. Bonds based on price are negative on the year. Some correlations. We look at the S&P to the dollar, where they're having a slight tendency to go in the same direction. Then the S&P to oil, where they're having a tendency to go in opposite directions. That's because oil is going up for negative reasons. And we look at the S&P to the 10-year yield, also a slight tendency to go in opposite directions. And then the 10-year yield to tech, also slight opposite directions. And then a shorter term yield, the 2-year yield compared to stocks, we're still pretty much neutral right now. Then some long-term studies. This is a monthly chart of the NYSE where we're above the moving average. So the long-term trend is positive. That's also confirmed by the Kopic curve, which is a momentum oscillator. It's continuing to go up. Then we look at a daily chart of the NYSE, and it's also still looking positive with the record high percent index. We look at a monthly chart of the S&P 500 above the moving average, so the longer-term trend is positive. The longer-term momentum continues to be positive as well. And then we look at the S&P 500 on top, and then we look at a ratio between stocks and commodities, showing how even though commodities are bouncing back, stocks continue to outperform. And here's a monthly chart of the S&P, and then another global measurement that we use, showing how the S&P is outperforming. And the KST is showing we're pretty much right on top of the moving average right now after it had been declining since the early part of 2023. Then at the very end, I make a list of everything that's positive. There's only one thing on the negative list right now. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. And everything on this list is positive. The growth value, when we look at them by themselves, copper, the British pound, and the euro, the euro's getting kind of close right now. Gold and silver. Silver's a new addition to the list. The dollar index, when you look at it by itself, the CRB index, the big software companies, the mega caps, FANG index, ARC, The low volatility ETF, again, by itself, but when you compare it to the S&P, it's been really underperforming. Staples, the Dow Jones Composite Average, all the bonds that we look at based on price, the tech sector, as well as the semis, high leverage loans, the Dow, the NYSE and Wilshire, those are broad market measurements. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. The micro caps and small caps are in an uptrend or in uptrends by themselves. It's just they're underperforming when compared to other indexes. All stocks and then emerging markets, and you won't be able to see this. At the very bottom is Bitcoin. Then we only have one thing on the negative list, and this is when the 50-day moving average is below the 200-day moving average, and it's the Japanese yen compared to the dollar. Thank you. I hope you found this helpful. As interesting as you might find this video, it's not necessarily meant to be used as a standalone video. I use it in conjunction with other videos that I produce each day and each week. That being said, I hope you have a very good weekend, and I will talk to you in the next video.